What if I told you that the Royal Bank of Canada, one of the 5 largest banks in North America, just disclosed a stake in an XRP ETF to the SEC? Or that a $3 trillion prime brokerage is now settling trades on the XRP ledger? This isn't speculation. This is happening right now in 2026. And if you hold XRP or you're thinking about it, you need to understand what these moves actually mean and what they don't. Welcome back to Crypto Investment Group. If you're new here, we break down crypto markets and blockchain trends in plain English. No jargon, no moonshot promises, just honest analysis. Today we're talking about XRP, specifically why institutional money is starting to move in its direction in 2026, what the real drivers are behind that, and what it could mean for the price going forward. We're going to cover everything: a quick background on XRP and Ripple, the actual institutional moves happening right now, why 2026 is a turning point, the technical strengths of XRP as an asset, a balanced look at price potential, and practical takeaways for you as an everyday investor. Let's get into it. Before we talk about what institutions are doing, let's quickly get everyone on the same page. XRP is the digital asset that powers Ripple's payment network. Ripple is the company, XRP is the asset. Think of it like how Visa is the company and the payment rail is the product. They're related but separate. Ripple was founded in 2012 with one specific goal: to fix cross-border payments. Here's the problem it's trying to solve. When a bank in the US sends money to a bank in Japan, that process can take 2 to 5 business days and cost significant fees. Why? Because both banks have to hold pre-funded accounts in each other's currencies, what's called nostro accounts, just to facilitate the transfer. That locks up billions of dollars in idle capital around the world. XRP solves this by acting as a bridge currency. Instead of pre-funding accounts, a bank can convert US dollars into XRP in seconds, send it across the XRP ledger, and the recipient converts it to the destination currency on the other side. The whole thing settles in 3 to 5 seconds, for a fraction of a cent in fees. That's the core use case, and for years, it was mostly theoretical. But in 2026, that story is changing, fast. Let's talk about what's actually happening in the market, because the institutional moves in the last 12 months have been significant. In late 2025, Ripple completed its acquisition of Hidden Road, a prime brokerage that was already clearing over $3 trillion annually for more than 300 institutional clients. Ripple rebranded it as Ripple Prime. Why does this matter? Because Ripple is now the first crypto company in history to own and operate a global multi-asset prime brokerage. That's the same infrastructure hedge funds, banks, and asset managers rely on for clearing, financing, and settlement. And in April 2026, Ripple Prime received a BBB investment grade rating from Kroll, the first crypto-affiliated prime broker to ever receive that designation. That rating matters because it opens the doors for pension funds, insurance companies, and regulated banks to work with the platform. That's not a small thing. In Q1 2026, RBC, one of the largest banks in the world and a designated global systemically important bank, disclosed a position in the Bitwise XRP ETF through an SEC filing. It's a small position by RBC's standards, but a compliance-cleared signal from a major bank that XRP-specific ETF products have crossed an institutional risk threshold. In February 2026, Aviva Investors, a major UK asset manager, announced a partnership to tokenize funds directly on the XRP ledger. Traditional finance firms aren't just watching the blockchain space anymore, they're building on it. Across Asia, Europe, and North America, established banks like SBI Holdings, Santander, and Standard Chartered have active Ripple partnerships for cross-border payment efficiency. SBI Holdings in particular has been one of the most aggressive adopters, leveraging Ripple's on-demand liquidity, or ODL, for faster, cheaper international transfers across Asia. ODL volume is projected to grow 30 to 50% in 2026 as more payment providers adopt on-chain settlement. One more piece of this picture is Ripple's stablecoin, RLUSD. Launched in December 2024, RLUSD is a fully reserved, NYDFS-regulated, US dollar-pegged stablecoin with BNY Mellon serving as its primary reserve custodian. As of 2026, RLUSD has surpassed $1 billion in circulation and is being used as collateral on Ripple Prime across hundreds of trading pairs. Here's why that matters for XRP. RLUSD gives banks a stable entry point into the Ripple ecosystem. Many institutions aren't ready to hold a volatile crypto asset on their books, but they'll use a regulated stablecoin. And the hybrid model Ripple now offers, where RLUSD handles stable settlement while XRP bridges currencies in real time, meets institutions exactly where they are. So why is all of this happening in 2026 specifically? A few key reasons. The long-running SEC lawsuit against Ripple, which dragged on for years, reached a resolution that gave institutions the legal clarity they needed to engage with XRP without fear of regulatory blowback. On top of that, the Clarity Act, which is working its way through the U.S. Senate, is expected to further define how banks can participate in digital asset markets. A survey of 351 institutional investors found that 25% plan to add XRP exposure in 2026, and the number one factor cited was regulatory clarity. XRP ETFs listed in the U.S. have crossed $1.29 billion in cumulative inflows. Having a regulated SEC-approved vehicle means institutions can gain XRP exposure through a familiar structure, without custody headaches. The XRP ETF landscape is still growing, and institutional inflows are beginning to pick up alongside retail. Global cross-border payments represent a $150 trillion annual market. SWIFT, the current system, is slow and expensive. XRP and the XRP ledger offer a faster, cheaper alternative, and Ripple is now deeply embedded in the infrastructure of global finance through its acquisitions and banking partnerships. Let's quickly cover why XRP actually works well for what it's being used for. Speed. Transactions settle in 3 to 5 seconds. Bitcoin takes 10 minutes or more. Ethereum can take minutes and cost significant gas fees during congestion. Cost. Transaction fees on XRP Ledger are a fraction of a cent, roughly 0.00001 XRP per transaction. Scalability. The XRP Ledger can handle around 1,500 transactions per second, more than enough for global payment flows. Energy efficiency. XRP uses a consensus mechanism, not proof-of-work mining. It's significantly more energy efficient than Bitcoin, which matters to ESG-focused institutional investors. Tokenization ready. The XRP ledger now holds over $2.3 billion in tokenized real-world assets, from bonds to energy tokens, and that number is growing as institutions explore on-chain asset management. These aren't marketing claims, they're measurable on-chain performance metrics. And they're a big part of why institutions are building on this specific network. Now, what does all of this actually mean for the price of XRP? Let's break it down honestly. David Schwartz, one of the original architects of the XRP ledger, made a market mechanics argument that doesn't get enough attention. He's clear it's not a price prediction, but it's worth understanding. When a bank uses XRP to move money across borders, the number of tokens required depends entirely on the price per token. Moving $50 million at $1 per XRP requires 50 million tokens, a massive amount to source and settle in seconds, creating slippage and friction. At $10,000 per XRP, that same transfer needs just 5,000 tokens. Clean, fast, and far less disruptive to the market. The takeaway? The more XRP is used at institutional scale, the more the network's own mechanics push toward a higher price per token. Schwartz himself cautions this is about liquidity logic, not a promise of any specific number. But it's a framework worth knowing. Here's another angle most people miss. Some argue that institutional stablecoins, like JPMorgan's JPM coin, make XRP irrelevant. Actually, the opposite may be true. In 2026, every major bank is building its own digital currency. JPM coin runs on JPMorgan's network. HSBC has its own. SBI has its own. Each one is a walled garden that can't natively talk to the others. Expecting every institution to hold RLUSD, or any single stablecoin, to settle across those systems isn't realistic. No institution is going to adopt a competitor's coin as their settlement layer. XRP solves this. It's neutral. No single bank owns it, no single government controls it. It's the agnostic layer that sits between competing stablecoin ecosystems and converts value in seconds. The more banks launch their own coins, the more fragmented the landscape gets, and the more demand grows for exactly what XRP was built to be. Combine that with the Schwartz liquidity argument, and the structural case for a higher XRP price gets stronger as adoption scales. That said, let's be honest. As of May 2026, XRP sits at $1.38 to $1.41, well below its $3.66 all-time high from early 2025. Despite the institutional infrastructure being built around it, the price hasn't followed. Why? Because 84% of XRP ETF inflows are still retail-driven. Institutional capital is waiting on regulatory clarity, specifically the Clarity Act. Intent is not the same as money deployed. Analyst targets range from $3 to $8 by year-end. Those targets are real, but so is the gap between the narrative and where the price sits today. The fragmentation thesis and the Schwartz argument are logical and compelling, but they remain a thesis until institutional volume on the XRP ledger actually scales. Watch for that signal. So what does all of this mean for you as a regular investor? Here are 4 takeaways. 1. Don't confuse adoption with price. Ripple's infrastructure is being adopted. That's real. But XRP, the asset, is not guaranteed to mirror that adoption linearly. Understand the distinction. 2. Watch the Clarity Act. This is the single biggest near-term capital for institutional capital to actually move into XRP. Keep an eye on Senate developments. 3. Position sizing matters. XRP has real utility and growing institutional interest, but it also has real price volatility and regulatory overhang. Whatever position you take, size it according to your risk tolerance, not according to hype. 4. Zoom out. XRP's story in 2026 is a long-term infrastructure play, not a short-term pump. The institutions moving in are thinking in years, not weeks. Consider whether that timeline aligns with yours. Let's bring it all together. Big banks and institutions are genuinely moving into the XRP ecosystem in 2026. Through ETF disclosures like RBC, through tokenization partnerships like Aviva Investors, through Ripple Prime's $3 trillion clearing network, and through RLUSD's growing role as institutional collateral. The technical advantages of XRP are real. The regulatory environment is improving, and the infrastructure being built around it is serious. But the price story is more complicated. The asset is range-bound, institutional buying intent is still waiting on a regulatory catalyst, and the full upside depends on factors that haven't played out yet. This is not a story of XRP is about to moon. It's a story of a financial technology growing up, and the question is whether you understand it well enough to make an informed decision. If you found this video valuable, do us a favor, hit the like button and subscribe to Crypto Investment Group. We drop new videos every week covering crypto markets, blockchain trends, and real investment frameworks. No hype, just research. Drop a comment below. Are you holding XRP in 2026, or are you waiting on the sidelines? We read every comment and love the discussion. And if you want to stay ahead of what's happening in crypto and institutional finance, make sure you're subscribed to the channel. We go deep on these topics every week, so you don't have to wade through the noise yourself. We'll see you in the next one.